It's 7 a.m. In a glass tower in Manhattan, a man sits down at his desk. Two monitors flicker on. Before the markets even open, his algorithm has already started moving $4 billion. His name appears on no official document. No financial report mentions him. And yet, he's been here for 14 years. Quiet, invisible, and completely indispensable. Today, I'm going to walk you through his story. And more importantly, the path you'd have to take to become him. A journey through 6 levels, 6 stages of a career in quantitative trading. From the fresh PhD grad who thinks he's been hired because he's brilliant, all the way to the legendary profit room, the one everyone dreams about but almost no one ever actually sees. And by the end of this story, you'll understand a paradox. The most powerful man in this entire firm is never in that room. He never wanted to be. Stick around, because what you're about to hear might completely change how you see modern finance. It all starts on day 1. Our protagonist, fresh off the plane, learns something cold within the first hour. There's an invisible but absolute line separating the people who sign the checks from the people who build the tools that move the money. These two worlds never overlap. Their names never appear together on any document. And yet they work a few feet apart from each other, every single day. He's 26. A PhD in statistics, physics, or computer science in hand. Base salary, around $240,000. With bonus, it can climb to $300,000. On paper, that's an absurd number for someone's first real job. He walks in with one certainty. He's here because he's brilliant. That's why they hired him. That illusion lasts about 3 weeks. His first strategy is beautiful. On paper, it's flawless. In backtesting, running the model against 10 years of historical data, it would have produced steady profits the entire time. A curve that climbs, almost without interruption. He's proud. He thinks he's found something real. Then a more senior colleague glances at his code for 30 seconds. One small fix to a timestamp, and the whole thing collapses. His model had been using information that, in reality, wasn't available until after the moment the trade was supposed to happen. In plain terms, his algorithm had been quietly cheating, looking into the future without knowing it. The perfect curve becomes noise. The signal he thought he'd discovered never existed. It was dead before it was ever born. That's when he understands his actual job. It's not to find magical opportunities. It's to avoid being fooled by his own mistakes. Discipline becomes the weapon, rigorously splitting data into training and test sets, so his judgment never gets contaminated by knowledge of what already happened. The firm he's working for manages around $60 billion. It ingests petabytes of data, volumes that dwarf what most financial players process in a year. And him? He has zero access to actual capital, none. His entire world is questions. The same one keeps coming back. Why did he believe in that signal in the first place? What exactly fooled him? That's level 1, and it's already harder than he ever imagined. 4 years pass. He's 30 now, and something has shifted. He's learned to answer the question before it's even asked. Before a senior partner can say, "Why do you believe this signal?" He's already asked himself, already answered, already prepared his defense. His pay has moved too, between $350,000 and $500,000, depending on the firm's annual performance. But here's the important detail. That number no longer depends mainly on his individual work. It depends on the entire firm's overall results. And his whole approach to research has changed. At level 1, he was hunting for the signal, that one brilliant idea that would change everything. Now he understands that's the wrong way to think. He doesn't kill his signals one at a time anymore. He builds armies of weak forecasts, dozens, hundreds of small ideas, each one biased in a slightly different direction. Individually, each is mediocre, but combined together in clusters, their individual noise cancels out. What's left is a thin, but stable, edge. Stable enough to survive the market's chaos. A strategy is no longer one great idea. It's hundreds of average ideas intelligently assembled. The genius here is no longer individual, it's collective, it's algorithmic. At this level, he also starts to understand the real hierarchy of the system. Researchers produce raw signals. Modelers assemble those signals into coherent strategies. Engineers translate everything into clean, robust, production-ready code. And above all of that, A small group of people decides how much capital gets allocated to each strategy. That decision is completely opaque, discretionary. No formula is ever revealed, and this is where he experiences his first real injustice. A strategy he spent 2 full years building, 2 years of his life, his energy, his focus, gets zeroed out overnight. No detailed email, no debrief meeting, just gone. The real challenge at this level isn't building anymore. It's surviving, saving, or finding a way into a strategy that's already underperforming, all under the eyes of decision makers he's never met and never seen. He's 34 now. He runs a small team, 3 researchers, 2 engineers, and a portfolio of strategies worth hundreds of millions of dollars. His salary crosses $700,000. And here's a small but telling detail. Once you hit that number, you start hiding the exact figure from your own family. Not out of shame. Just because the number itself becomes strange, hard to explain, hard to carry socially. The core challenge has shifted yet again. At the start, it was about creating an edge. Now, it's about preserving one. Why? Because every signal has a half-life. That's the defining image of this level. The moment a market opportunity becomes visible to others, the market reacts and the edge starts to fade. Some signals survive for years, others die in a few months. He becomes, in a way, a farmer, constantly planting new signals, not just to find new ones, but to study them, to understand, by watching them grow and fade, why the old ones eventually die. His relationship with the world changes too. The news isn't human stories anymore. It's time-stamped data points. A hurricane isn't a tragedy, it's a measurable disruption in shipping traffic. An earnings call isn't an event. It's just a string of numbers waiting to be parsed. To stay ahead, his team keeps feeding the model's alternative data, satellite images of retail parking lots, real-time ship movements, anonymized car transaction records, a few hours, sometimes a few days, of lead time over public information. That gap is everything. The obsession with signals never turns off. Even at dinner, his mind keeps running the numbers. And meanwhile, something else is happening in parallel. Machine learning systems are starting to generate their own signals automatically. No human input required. And this is the moment he finally understands who the Nameless man from the start of this video actually is. Not a trader, not an executive. He's the one teaching these machines, the one building the systems that will eventually build the firm's future on their own. Age 38, he now runs his own book of capital inside the firm. His pay is tied directly to the profits he generates. In a good year, anywhere from $1 to $3 million. In a bad year, it can drop to 0. At this level, one truth becomes brutally clear. Only performance matters, not effort, not hours logged, not the elegance of your reasoning, the result, and nothing else. Risk management becomes an absolute, almost mechanical constraint. An automated system can slash the size of his portfolio the moment drawdowns get too large, and he has 0 say in it. Why does the system have to be this ruthless? Because there's an unwritten rule in this world. Being right but early, which usually means losing money before you're proven correct, can be worse than just being wrong. Then comes the day an unmodeled correlation wipes out several strategies at once. Within hours, his leverage gets cut. The whole process is disciplined, mechanical, and completely silent. No drama, no shouting, just numbers shifting on a screen and access quietly shrinking. The money on the table is staggering. Management fees, performance fees, the totals are enormous. And yet even the millions he personally earns feel like a rounding error against the billions the firm generates as a whole. And here's the key moment of this level. The people who decide how those profits get split have never once shown him their faces. Never. He's running hundreds of millions of dollars. He looks powerful from the outside, and yet he's locked out of a room he can't even locate. The higher he climbs, the more he realizes the real room, the one where the actual decisions get made, is never the one he thinks he's standing in. Age 43. His role transforms completely. He becomes, essentially, an elite salesman. His audience now? Sovereign wealth funds, pension funds, the world's largest institutional investors. His job? Sell something deeply abstract, not a product, not a formula. Trust. Trust in an algorithmic black box that nobody outside the firm could ever fully understand. His pay crosses into the multi-million-dollar range. But here's the catch. That number now has almost no connection to the technical reality of the system. He doesn't write code anymore. He doesn't build models. He sells credibility. And it's at this level that the real product finally comes into focus. It's not returns. It's long-term credibility. The ability to say year after year, "You can trust us." But cracks start showing. Periods of underperformance, conflicts between the firm's founders, senior people quietly leaving with no public explanation, and the dogma he's believed his entire career, the idea of the perfect system, starts to crack too. Because he realizes this system was built by human beings, and the collaboration between those humans isn't nearly as smooth or as interchangeable as he was led to believe. Then comes a turning point. For the first time, he sits in on a profit distribution meeting. And there, a revelation hits him. The human social system behind that distribution redistributes far more than any technical logic could ever justify. More than a decade of belief, of certainty, undone in a few minutes. Age 47. And finally, the room. The one everyone talks about. The one everyone imagines as vast, gilded, almost mythical. The reality? A surprisingly plain room, a table. And on that table, a single document setting the discretionary share of the year's profits. Here's how it actually works, in simple terms. Investors put up the capital. In return, they take their cut, their fees, before anything else gets divided. What's left gets split among a small group of hand-picked individuals, the partners. And here's the crucial part. Neither the researchers who actually generate the signals, nor the investors who provided the capital, are in this room when the final split happens. The researchers already got their bonuses, a small slice of a cake whose recipe they were never allowed to see. And this is where he understands the ultimate paradox of this entire story. The nameless man, the one whose model moves $4 billion every single morning, the one we opened this video with, is never in this room. Never has been. And it's not an oversight. It's not some injustice done to him. He never wanted to be there. He never wanted capital management, titles, or representation. He wanted to solve a technical problem. And that's exactly what he does, day after day, at his desk, at the very heart of the system, completely detached from the politics and the money games swirling around him. He's the keeper of the knowledge that keeps the whole system alive. And that's when our protagonist understands something even bigger. The firm isn't really its founders. It isn't really its managers. It's not even, fundamentally, its portfolios. The firm is a body of collective knowledge, built up over decades by hundreds of researchers and engineers. The system has become smart enough to function without any single person. But it's too complex to be replaced as a whole. And now, that system is starting to teach itself. Through machine learning, it proposes new signals, retires old ones, improves itself continuously, more and more, without human hands involved. And here's the final irony, the sharpest one in this whole story. The people most at risk of being left behind by this new era aren't the junior researchers. They're the exact people sitting in that profit distribution room. Their line on the spreadsheet stays frozen in time, while the nameless man's keeps evolving, adapting, growing right alongside the system. And that's when he finally understands the oldest secret in this industry. At this level, it stopped being about money entirely. It's become a fascination with an intellectual challenge that long ago outgrew any material ambition. The names that actually matter in this industry never show up on public documents, and the people who actually matter want it that way. That's it. 6 levels. 21 years of career, compressed into one story. From the fresh grad who thinks he's found gold on day one, to the invisible man moving billions without ever wanting credit for it. If you enjoyed this look inside quant trading, check out our video on career progression at a firm like Jane Street. It shows you the other side of the desk and ties everything you just heard together. Hit like, subscribe so you don't miss what's coming next. See you in the next one.